Good afternoon, Chris. Thanks for joining me on what's a sunny day for a change, and we're now in July. How are you keeping?
We are in July, indeed. Second half of the year, which is very exciting, except it is exciting because it's nearly summer holiday times and everything else. But it's been a tricky year. You know, we've gone through a tricky first 6 months of 2022. But as always in the investment world or about anything in life, it's how you respond to something that really matters. So I think it's going to be 2022 is not going to be terrible. There's been some difficulties out there. We can all see that as investors or thinking about the economy or our day-to-day lives or anything, but we still live on. And that's the key thing. The key thing is to keep on moving forward.
Yeah, as you said in your latest commentary, the world's still spinning, isn't it? And we've got to sort of continue our financial planning on that basis. But you're absolutely right. I think the first 6 months of this year has been a horrible time for investors. For the day-to-day person that's concerned about their pension account or their investment account, it's felt that month on month, we've just seen valuations degrade further. But I suppose let's look at some of the positives then. I feel that for the most part, the COVID challenges that were certainly around last year and obviously in 2020, they seem to have calmed down. And we've seen that in China with their COVID policy seeming to be eased up in certain cities. We've also seen that there's been progress in other areas with central banks and generally, you know, looking at where the monetary supply is coming from. But clearly the inflation risk and the ongoing geopolitical risks in Europe, they're not going away anytime soon, are they?
No, you're absolutely right, Rob. I mean, there are some things which have got better, thankfully. COVID being the most obvious, thank goodness for that. That really was horrible and tricky, as we all know, over the last 2 years. So the world is a bit more normal in that sense, but new challenges have picked up. Here's the thing, though. I know that we're all worried about, and quite correctly so, about inflation, about the cost of living, about whether we can get our Christmas presents for later in the year or things like that. All the challenges of living life in investment markets and related. The thing is, though, is that we go through these challenges quite regularly in economies. Certainly, if you look over the last 5, 10, 15, 20 years, there have been quite a few periods of volatility and uncertainty. The world, though, it has this funny capability of getting better, mainly because people learn, some politicians, many just general people in day-to-day life learn that actually you make progress through improving stuff, through not running away, but actually thinking, okay, how can I improve things? Whether you run a business or work for a business or already are a pensioner or educating yourself or driving something for your family, you learn things by participating and pushing through. And that's what we are at the moment. I know people are, and I quite understand it, are correctly very concerned about inflation, cost of living, and as you say, Rob, geopolitical matters. My feeling at the moment, and I might be wrong, and I guess we'll find out fully over the next few months, my feeling is concerns about those issues are currently at a peak level. And that's often the way it works with financial markets. I do realise that things like interest rates going up is a bit different from many of the last decade or so. The fact that we have some geopolitical matters sad matters still in Ukraine, that is a little bit different. It's very sad for the people there, but something which as investors, as thinkers about global progress, it's a new challenge. But I think we will push through this. And I am still optimistic that certainly anybody who's thinking about investing their money over the next few years, we actually will see a better world as the 2020s progresses. And here's the thing, final point about investment markets. Investment markets always look forward. I reckon that they look forward somewhere between 6 and 18 months. And so if you like, what the volatility you've seen in the last 6 months is people thinking about what's going to happen over the next 6 or 18 months already. And so the fear about, are we going to see a recession? Are we going to see higher interest rates? Are we going to see lower house prices? Are we going to see other problems? A lot of that is already factored in. So I'd say to people, please don't worry, because volatility has happened many times before, but the key is to remain involved. The worst thing I think anyone could do is to panic so much to say, my goodness, please move me away from all of this right now. That I think would be a mistake. And I certainly think anyone who's thinking about trying to improve their lifestyle, their pension, their investment targets, whatever they might be in their life over the next 5, 10, 15 years, it's going to be all right. That's my personal feeling. And we shall just keep on looking and keep on thinking about it.
Yeah, I think it's positive to have that message, isn't it? Because as financial advisors, clearly when we sit down with clients, we're looking at the longer term objectives. So it's easy to get pulled down in the short term negativity, but you do have to have an eye on the long term future about, what you're trying to achieve with your money. Let's look at something then in regards to inflation. So a few months back, we sat here and we sort of said we can see that potentially the late summer might be the time in which we see peak inflation. Do you still think that's true, Chris? Do you think it's going to top out late summer?
My feeling is yes. Inflation is a strange number in terms of how people work it out and think about it. There's a lot of people, a lot of big analysts, big thinkers about investments. They always look at, oh my goodness, what is the number compared to this time last year? The trouble is, a year ago, inflation was very low. And it's no surprise that we've got some advances. And as you can see, some quite high advances at the moment, between 8 and 10% on average. But actually, as we move through this year, inflation, I think, is going to start to slow down. And I would still say by the end of this year, it will be lower. And certainly when we look at 2023, materially, notably lower. There'll be a few reasons for that. One is that clearly the economy is slowing. It's not impossible out there. Fortunately, as we've talked about before, jobs are still being created, which is great. However, we're all being a bit more prudent with our money. And as a consequence, prices, I think, will start to slow down. Because if people aren't spending money, then any business is not going to look to raise their prices unless they want to put themselves out of business. So I think there's, for many reasons, as comparisons get sort of easier, and also as we get to sort of this point where people are starting to realize that we're going to be much more prudent with our money and businesses start to stop raising prices on everything, inflation will start to naturally slow. So my feeling is if we could move this forward another 12 months, we would see inflation probably at around about a 4% level, probably about half of what we see today. Frankly, that's a number which is not too much of a concern, certainly for anybody who is my sort of age, who's seen many inflation numbers much higher than that. So hopefully that tells people that things are slowly going to get better on the inflation front. What I would still always be more focused on is what's happening on things such as employment, because for an economy, that's even more important. And I think what the government and the central bank will be focused on is that combination of an admission that there is some inflation, but hopefully not too much in the future, but there's a continued generation of new jobs. If you get that combination, a little bit, but not too much inflation, but the continued creation of jobs for people who want to move back into the workforce or do different things in the workforce, that's something that can work quite well for an economy. So that's why I'd say I'm not too pessimistic about the next year. I actually see more opportunities than threats. I know it doesn't feel like that today when you have to do your gas bill or your food bill or your bills for your car and stuff like that. I do recognise that's very obvious for us all, but it's always how it moves on and how it's going to impact the next year. So hopefully, please don't be too concerned. I'm hopeful that it's going to become a bit better. There's still tricky stuff out there. There is no doubt about that, but that's always the nature of the world. Markets, though, are always focused on the future already. And as I say, I think a lot of it is already priced in. That is my personal feeling.
Brilliant. Thanks, Chris. Last question, just to wrap up then, and drawing on your experience being a fund manager. There's been a lot of talk with investment managers at the moment of a shift, of a switch from growth companies to value companies. Can you just tell us, for everyone's benefit, the difference between a value company and a growth company?
In short, growth company, all companies like to grow. We can all understand that. It's just that some companies are in areas which are very exciting. I mean, technology a decade or two ago was this suddenly very exciting new thing, or mobile phones or something like that. And now we get various bits of special areas which have just been newly developed. Whilst a value company tends to be an area which is well known to us. It's been around for a long time. food, for example, your supermarket, or perhaps a clothing shop or something which is a bit slightly more mainstream, or maybe a chemical company or something like that. So the stock market tends to be split between these sorts of different types of companies. And so often when you become a bit more concerned about the world, about the backdrop, you say, right, we want to invest all our money into something a bit more safe and cautious. The supermarkets, some of the areas that the pharmaceutical companies that are quite well known, they pay a dividend, they're sensitive. So I can understand why many investors are saying, wow, we've got to have less of this new, exciting, let's big hopes for the future technology and other scientific names, a bit more focused on some stable stuff. That is always a good approach. The thing about the UK market, funnily enough, is that we've already got this very high exposure to the more kind of safe and steady areas. It's actually been America that's been a bit more focused on these growth spaces. So I think this change, frankly, has been happening now for the last couple of years. And suddenly a lot of people have said, wow, this is what we've got to do. But as always, I think many investors have already factored it in. And I know you and I, Rob, have been talking about it for at least 2 years, if not longer. So maybe we've been mildly foresightful on this, but certainly it's going to be a theme which is going to continue to be important for people over the next year or so, because the world is not easy. We can all see that. And so therefore, some sensible companies, dividends, access to an area which has a lot of strength to it, underlying strength to it, makes a lot of sense. And so that's why I can understand people looking more towards value investment. So that's how people should always think about it.
Great, excellent. Thanks for that, Chris. Bit of a jargon buster for us on a Monday afternoon. That's brilliant. Thank you, as always. I look forward to catching up in August. Let's, as always, hope for more progress and more positivity between now and then. We know it's not going to be a smooth ride, and investments never are, really, are they? As long as you're looking at the right objectives, then you've got to take the rough with the smooth.
Precisely. July is going to be an interesting month, as always. Lots of companies will be talking to the stock markets about how they see the world. And so lots of new insight is always good. If people are telling us lots of new information, not all the information will be great, but it will be insightful. And that's the main thing. So we'll always be looking forward. And as I always say, you've got to look forward with confidence, because the world does get better over time, just not all the time.
Excellent. Thanks, Chris. See you soon.
See you soon.